Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Hello, we are back. Julian Barnes, Broker Daily Uncut. Welcome back to another episode. I've got the usual suspects, Eva and Costa, with me. How are you guys today?
Yeah, great, thank you.
Doing well. Good morning.
Well, it's a big day today. We're recording first thing this morning. We've obviously got a rate decision today. I was about to call it a rate hike, but let's not say that.
All signs are pointing to that.
Exactly. So obviously that's going to be very much on our agendas on both sides here. How are you guys feeling?
Yeah, look, everything's pointing to another hike. All four banks have said it's happening. In the last week or two, we've seen many banks and lenders putting their fixed rates up. Look, I'd love to say let's hope for, the rates on hold, but I really don't think that's happening. And obviously, with everything that's happening, not in just Australia but in the world, I think it's wouldn't say 100% happening, but very close to it.
Never say never. But,
never say never.
As you say, I mean, I think inflation's kind of sitting, the CPI is sitting about 3.8%, which obviously is miles above the target still. And global risks, the rising oil prices, Middle East tensions, that's not going to do anything good positive for it.
Well, that's just going to flow on to higher transport costs, higher, oil prices and all that sort of stuff. And it's pretty much almost nothing's guaranteed, but it's almost guaranteed that they'll increase rates today.
No, and the thing is the major banks aren't just forecasting one hike right now. They are forecasting two at the moment. So one now on the 17th of March, and then another one in May at the next decision, which would bring it to 4.35% for this cycle. How is that kind of changing your kind of discussions with your clients at the moment?
Look, there is a lot of clients starting to not put things on hold, but actually re-evaluating what they should be doing and making sure they can afford investing again, or even the mortgage they currently have. And I think as brokers as well, when we plan for clients' portfolios or what they're going to do the next 6 months to 12 months, we do need to make sure we tell them that, what's happening today or what they can service for today might not be the case in the future. So we need to have, on top of the bank's buffer, have a buffer ourselves, making sure that we're not saying, hey, you can buy a property for $1 million, and in 6 months' time, they buy one for $1 million, and they actually can do 800 at that time. So it's going to be a tricky time for purchasing properly and to make sure that people actually know what they can afford.
Yeah, where have the fixed rates been going at the moment? Have they been on the rise?
They've just been going
well?
up. Yeah, all the banks have, and even your INGs and Bank West and all that sort of stuff, they've increased all their fixed rates. And what Eva was saying, just with clients at the moment, the inquiries are still coming in. They're still coming in strong. But I think they are asking the question, where do you think, rates and all that are going to go? I think you've now just got to implement that buffer because rates are looking to go up most likely today. And like you said, again in May. So you've just got to sort of plan for that buffer and, instead of going off today's interest rate, add an extra 0.25% on top just to make sure that client does have that buffer if another rate rise is to come down the track, so they're not stuck.
Absolutely. And I there's kind of two segments of the market that I've been quite interested in, which I'd just like to pick your brains on. So the first one obviously is first home buyers. We talk a lot about first home buyers. The government talks a lot about first home buyers. Everyone, it's a very important segment of the market, not just economically, but socially as well. Figures showed that inquiries from would-be first home buyers, this was in 18 to 25 age group, grew 9.8% in the year to February. 26 to 30 cohort, 3% in the same period. Despite kind of cash rate rises and stuff, there's still inquiries. We're also seeing from APRA, property exposure statistics, showing that there's been a wave of loans to these first home buyers with deposits of 5% or less. Banks have written $5.4 billion in new owner-occupier loans with deposits of 5% or less in the 3 months of December. That's an increase of 2.1 billion or 63% on the previous quarter. Obviously, this is going to create like a much larger kind of impact on just for, two obvious reasons. Obviously, they've got a much higher LVR, and secondly,
they're borrowing at 95%.
Yeah, exactly. And secondly, they might not have the savings to kind of offset at the same
Cover
time.
that.
So there's kind of two aspects
most
to it.
people that would be using this is because they don't have savings at all. They're really scraping through to actually have those 5%. Then the question of, okay, is it actually because they were renting, they couldn't save at the same time? And so that really is positive for them. They can just get in with less. But a lot of them actually have, income that they can afford to have a hike or two. The issue was to save at the same time as renting. And then there's also always going to be those people that went for this that also have very, tight income to afford what they took on as a loan. And that's where it's going to be really tight for them if it does increase by 0.25 and again 0.25. That can add a few hundreds in your mortgage repayment, which if you're tight already can be a lot.
Yeah, and it's growing now, so it's kind of the first stress test. Obviously, you have serviceability and stuff already in place, but like for these people, like it's going to be their first kind of stress test of seeing what happens when the rates go up.
Well, the banks assess you as with a 3% buffer. So on paper, they should be able to afford it. So there shouldn't be any issue there. I guess it comes down to the lifestyle that people live where, they spend money and do whatever and they're entitled to that. Well, recently, I think last week, ANZ came on board with the 5% deposit scheme. So those numbers don't surprise me. They're actually larger than I thought they would be. So it does seem like it's a growing sort of segment of the market. And that's probably why ANZ have now jumped on board. But it will be pretty interesting to see how it goes now that interest rates are most likely going to go up and potentially go up again. But with the 3% buffer, they should be okay to be able to afford the repayments. It's just going to have to maybe...
Still a dream for most people. Like
exactly.
You just want to buy a house. If you can, I think that you would do it, regardless if the rates are potentially going to come up or not.
That's why I want to ask you. So obviously at Broker Daily, we did a lot of reporting around, when they lifted the caps, kind of changed the schemes. You saw this big wave of first home buyers, big waves of inquiries and big waves of actual lodgements itself. Yep. Do you think that's kind of pent up demand, or do you think that's going to continue long into the future, particularly with these rate rises and these kind of this kind of less certain, potentially a new cycle on the horizon? Do you think that is something that's going to continue, going up, or is this just kind of pent up demand, if you see what I mean? Well,
initially, as it came in, you've probably got a lot of people that want to be part of the scheme. So everyone's jumped on board to it. So you're going to see that massive hike. I think over time, it will come down, not to say that it's not going to be popular, but it's coming down because sort of the mass market has hit it. And then there's just new people coming into the market who want to take advantage of that scheme as it's been in. So it will probably come down a little bit and then probably just sort of remain steady as time goes on. So that's what I think.
Yeah, just trying to remember like my thinking as a first-home buyer. I don't think knowing that we would have rate hike would have discouraged me from saying, I actually want to buy my house, I'm saving. It's not something you decide within a month or two. It's like, it takes time. It's a decision that you make, with your partner or sometimes on your own. But, and really, if that is something that stops people from buying their home, that's a bit sad, right?
Yeah, absolutely.
And that's the market. It goes up and down. And if that's an issue, you can always fix it. Right?
Well, you run the risk of then having to pay more. Like we've seen property prices are just going up. Like they may stabilize over time. But if you sort of hold back, if you can't service, that's a different story. But if you're servicing and you're sort of saying no because of what's going on at the moment, in a year's time, you're most likely going to be paying more for that same property.
Yeah.
And you're not going to be paying more just in the price, but your repayments and your stamp duty and all that, because that all affects. So
deposit's bigger.
It all knocks on. And just quickly before we take a break, there's one other part of this that I want to just unpack very, very fast, which is obviously investors as well. This is obviously going to impacts every part of the market, but investors have been moving even faster than first home buyers. And that has kind of, this lift has kind of been central to kind of APRA's caution around debt to income and all these kind of different issues around there. How do you think this might change kind of the way that investors are looking at the market and their behavior, and also your advice to them, I guess?
I think investors, that's not typically something that stops them. Obviously, the only difference is their borrowing capacity will reduce because of the rate hike. So And that's where it gets a bit tricky is then they target market is the same as first home buyers and it is those more affordable areas and it's where we see prices get up. So that's where a lot of competition is going to happen. And typically that's also where buyers agents push people to buy because they know that's where the first home buyers are also buying and that's where, everything happens. So that's going to be a interesting year, I think, for those markets that are the most affordable.
Yeah, I think it's a good time to buy if you're an investor. When there's doom and gloom around, that's when everyone jumps into the market. So when times are good, you're already there and you reap the benefits. So in short, I'm bullish on that.
Ideal. We'll take a quick break there. Back in a minute. Welcome back, Broker Daily Uncut. Eva, Costa, and myself, Julian. Now, Western Australia is always on this podcast. I never get bored of talking about Western Australia. An amazing state, but obviously with some pretty interesting supply issues there. Now, I covered a bit recently, quite an interesting new development over there. The Western Australian government has extended its stamp duty concessions for off-the-plan and under construction homes to help address the housing supply shortage. So now, for the first time, survey strata properties will be included, which is a lot of different smaller developments. No stamp duty will apply to eligible off-the-plan purchases up to $800,000, with concessions tapering above $900,000. So there's plenty there. When I talked to brokers, there was a variety of different thoughts about where this may lead, but it was broadly welcomes. So I guess I'll take it over to the floor. What do you guys think?
Look, I think in WA, 800,000 will actually cover quite a lot of the state, right?
Yeah.
So that would help a lot of people. Is that going to help the price issues? Probably not. It's going to probably push it, but it will help, I guess, supply.
Yeah,
and
absolutely.
more development happening. So that's always a good thing.
Well, you've got the thing where it's good because it will help supply, and I guess people are just going to be like, well, the discount that they're getting is just going to go into the purchase price of a property. But on the flip side, if you don't introduce that, then prices are just going to go up. But at least you're bringing supply to the market to potentially bring down prices or stabilize them. Whereas if you do nothing, it's just going to keep on going up and up and up. But at least they're bringing supply to the market.
Yeah, absolutely. And you've seen, we've covered this, how supply is just so marginal in the state. And you're seeing other issues, which I'm looking at right now. And I want to unpack a bit more about how people are kind of sitting on their houses before they buy a new one and how bridging loans are actually on the rise because of that. When I talked to brokers over there, their view was kind of exactly what you guys said, which is it's not going to make prices come down. And that might not be the point of it, although the government may not say that's not the point. The idea is that can we get some
supply?
Get the gears grinding on actually building properties, open up some new areas, open up, some of the smaller kind of plots that could produce a variety of different properties that people actually want to buy, and also just give developers a bit more wiggle room, a bit more incentive to actually build as well there.
Yeah, well, if
that's
you come
what's needed. And that's what's needed everywhere, not just
I was going to say, if you look at Sydney, it's so hard to get up and to build anything. And, they always talk about there's a housing shortage. Well, yeah, there is, because you're not making it easier for developers to be able to build. Yeah. They're ready to go, but like with everything that they have to jump through, some of them just think like, what's the point?
Yeah.
And, an incentive like this allows them to do it. And if prices go up, so be it. But if you don't do it, like I said before, they still go up. But at least this way you've got properties.
It might just potentially slow down the growth a bit there. I think the last 6 months it was still double digits in Perth.
In Perth, yeah.
Which is incredible because they've had a really good run over the last few years.
Well, clearly shows that there's a housing shortage if they're still hitting double-digit growth.
Yeah.
Yeah, absolutely.
It's a bit of a two-speed market in Australia, right? Like Perth and Brisbane, like full steam, and then Sydney, Melbourne have just flattened completely.
Slowed down. Yeah, but obviously the auction statistics only show one, but like clearance is doing really well, and like it is moving, and it kind of depends who you talk to. Like I remember talking to one Sydney broker, kind of said it totally depends on the property here. Some things have really slowed down. Obviously, you look at some of the kind of more regional parts of Sydney, the suburbs are doing very, very well still. And obviously, I covered a bit about the regions as well. You're seeing more and more professionals move out there as well, which is kind of changing the landscape. They're coming out, pretty cash rich and looking at investments, looking at different things like that. So that's completely changing the landscape there as well.
Yeah.
Well, I think that's great. You can get the lifestyle, go up north, go down south, live along the beach. You can work from home now as well. And, you can sell up whatever you have in Sydney, or if you don't have in Sydney, you can buy a reasonable house in those regions and you live a pretty good lifestyle.
Look what we mentioned last week with Newcastle having maybe a fast train to Sydney.
Yeah.
That would potentially, that's...
And the remote working revolution obviously has completely changed.
Yeah, look, I live an hour and a half from this office, right? So what would that be to just go a bit further? And
well, they're saying it's going to take an hour on the faster rails to come. Like,
if you can work from home or travel fast to an office, that changes everything. And then why not live a bit further and pay half what I would pay?
I talked to a broker who worked in Port Macquarie. Interestingly, had moved to Sydney. Don't get any ideas, guys. He moved from Sydney. And he said, a lot of the people that he was kind of working with were from Sydney, Melbourne as well. And that he said that, a lot of them had jobs where potentially they might have to go to Sydney or go to the city every month or so, and they'd fly in. Some of them, he said there was doctors, insurance people, lawyers, different kind of things where you can do the majority of it at home. Obviously, you still have an office that you still need to check in. You still have to go to meetings. But if you can kind of time that, then it's completely changed it. And obviously, he said they'd already bought in the city. So they had a lot of cash there. When they came out, they could buy a much larger, or potentially start investing as well.
Two clients that have moved up to Ballina.
Yeah, something I thought was interesting from the broker side is he said one issue is that those kind of people they often move with their brokers, so they still have their Sydney broker, and they ring their Sydney broker. They're not using the brokers up there, so he's like trying to bring them over, to transition them to the regional brokers is always the challenge.
That's good. I think COVID helped with that for sure. That's one of the benefits of it. And you can't beat lifestyle and life balance. And I think working in an office 5 days a week is a bit outdated.
Not if you don't need to.
It's getting outdated.
A lot of things are done online, and employers can sort of monitor what goes on their computer for emails and log in and all that sort of stuff. So it has made it easier for employees to find out what's going on. They're not just sleeping in the middle of the day or, going for a surf. They may knock off a little bit early and go for a surf. But, I'm all for it. I think it's great. It allows people to move and allows those regions to get more of a population. And that then brings infrastructure, that brings businesses. And then that flows over into the regions and creates sort of like a bit of a lively town there as well. Gets the ball
rolling. And there was some really interesting kind of stuff there where, so there was a survey. It was like over 70% of Australians were saying that regional areas are drawing more talent than before. So there's that kind of this view that the regions are full of very talented professional people, which is hugely important to kind of bring more people in. Is this idea that these are great places to live, and they are. I'm interested just very quickly, from a broker's perspective, what are the kind of positives and negatives of this kind of change where, brokers are working more and more from home or from, remotely? Brokers don't necessarily have that kind of high street presence as much as they used to. How has that kind of changed the industry?
I think it's easier. We can do a lot more. Like, I remember 10 years ago having to drive to people's home, or they would come to the office. It would, you drive there, it takes an hour. You meet them, it takes an hour. You drive back, it takes an hour. Yeah. You've seen one client, it's half the day's gone, right? And now you can just do this on the phone and So I think the speed is one thing, and you can deal with a lot more people, help a lot more people in a shorter time.
But how does it work with kind of lead generation and stuff? Because obviously, you don't see.
You see people. I think people still recommend you to friend and family. They still talk about it.
I think people accept they don't physically need to have someone
see you,
next to them to discuss alone. Like my accountant, I haven't seen the guy in 10 years. I don't need to see him. Like, in the end, what we need to talk about can be easily done on a phone call or an email. And I don't need to see you to talk to you about it. So I think people have just come to that realization that it just doesn't need to be like that anymore.
Absolutely.
Saves them time too.
It saves everyone time.
Yeah. We're getting busier and busier, aren't we? Anyway, we better take a quick break there. Back in a minute. Welcome back, Broker Daily Uncut. Now, I had some pretty interesting statistics come. Well, interesting or worrying, depends who you ask, Statistics come over my desk the other day about Gen Z increasingly turning to AI and finfluencers for their financial advice. So this is from ASIC. They warned that kind of young Australians are relying more and more on AI and social media for their financial advice. So they found in a survey that 63% of Gen Z use social media for financial information, while 18% say they use AI tools to make financial decisions. Guys, what do you think about that?
Speechless.
In short, I'd be taking everything anyone says on any social media with a grain of salt.
Yeah.
I wouldn't believe that and go implement it. Speak to an accountant who would be able to give you proper financial advice that they've studied and know the industry and know the policies and stuff like that. I wouldn't be taking as gospel.
It's very generic what they're talking about. It doesn't apply to everybody. It's just and you can really there are financial decisions that you make that are not reversible, and then you're screwed.
Yeah, absolutely.
Right?
Absolutely. And
There's things you can't undo. And like, for example, you go and buy an investment property, you will not be able to get all those first home buyer benefits ever again. It's gone.
Yeah. And
right? So there's a lot of things that that can't be undone, and it's going to be very costly.
Yeah.
And I can think of a lot of them.
Yeah, and you've got to think here that, well, I think there's two sides to it, because AI and social media are two very different things. So on social media, I'd say, what does that person stand to gain? You know, why are they posting? What's in it for them? And obviously, you know, we've talked a lot about this on different podcasts on Broker Daily about, you know, where should financial advice be? You know, where should you be getting this from? And is it too good to be true often? And also, as you say, when things go wrong, where will these people be? They're not your financial advisor. They're not going to be there for you. But then on the second half, at least with social media, you kind of know who's saying it. With AI, you don't know if you...
I think it's a great way to start, actually, to get ideas, to actually go to see a financial planner and ask the right question.
Yeah.
With a bit of knowledge already, a bit of understanding of, okay, what might be right for me.
Yeah, sort of direct the discussion around what you've heard. And there's nothing wrong with that.
Yeah, I think that's a good idea to start there, to get ideas, to get a bit of information. But look, I use it too sometimes to put things together. And obviously I know a lot of it as well. And there's so many wrong things. And I actually saw once on social media someone making jokes about, are those mushrooms eatable? And then, you know,
I saw that. Yeah. And then you die, and then it says, absolutely, the mushrooms aren't edible.
I'm sorry about this. It's just a mistake. Sorry.
Well, it's like that one where I want to take my car to the car wash, and then it just goes, walk up there. And I'm like, well, but I want to take the car. And I was just like I said, take it with a grain of salt.
Yeah, but it does have good ideas. It's good general ideas, obviously not applicable to everybody, not good for everybody.
Yeah. Going back to lead generation, so I had a really interesting conversation with one of the keynote speakers for the Better Business Summit over on The Advisor, Russ Easter. He basically looks at kind of lead generation and marketing. He basically was telling me how much more and more people are, it's all about, rather than SEO, it's AIO. Like, how do you, when someone types in, who is the best broker in Parramatta? How are you at the top there? How can you make sure that you're at the top there? And he's like, this is such an important part now. You know, this is you have to be there, because as you say, that there are important parts to this. You know, that if you can at least try and find some level of kind of information, and it dips your toe in to actually start finding good people, and you know, people to actually reach out to get the ball rolling on your property journey or whatever other kind of lending journey. That's great. And it's important for brokers to try and figure out how they can be a part of that in a sustainable way.
I think it's also dangerous because you may have a really average, let's say, or poor broker that's just really good at putting themselves at the top of the results. And you might have absolutely great brokers that just don't really care about you know, all of this, and that just miss out on getting new clients. So it's all flawed, isn't it?
What about on the other side? So on the broker side, where has AI kind of helped you guys to kind of?
Well, quickly, as most brokers will know, doing servicing calculators and all that sort of stuff, they've brought out a new AI model called Jiffy, and we discussed it a few weeks on the podcast when it came out. And I've been using it quite a bit for a lot of my policy questions and all that sort of stuff. It's saving me a lot of time. You don't have to constantly call the BDM. And then when you call in the BDM, you've got to put that file on hold a bit until you speak to that BDM. And then you may miss their call, and then you have to call them back in later. And then you may not get the problem solved till the next day. Whereas so this Jiffy thing, it's actually been really good. Like you can talk to it like you talk to ChatGPT. And if you're after a policy question or want to know something and the bank that you're trying to refer it to doesn't work, they'll also refer you to another bank that does it. And then you can go into quite detailed responses with it, which I found very, very helpful. It's saving me a lot of time, and I'm absolutely loving it.
Yeah, I won some fight with that too, where assessors from the bank were like, well, we don't do that. I'm like, yes, you do. And no, but you know what? The Jiffy actually, they tell you the policies, but they also quote like it's the article 10.2, whatever.
Yeah.
So I actually went back to the assessor saying, well, that's where it is in your policy book. And they're like, oh, okay. All right, approved.
You have that backing.
Humans can't remember everything. And we can't remember every single policy. Like there is thousands.
And constantly moving policies as well.
That's right. It's constantly moving. And so it gives us as well like authority to say, well, it's not just me thinking, I heard that from somebody and I think you should approve it. It's like, that's there. Black and white in your book. Yeah.
So that's been really good from a broker standpoint. And I'm benefiting a lot out of that.
Yeah, absolutely. I think that's all we have time for today. God, time flies.
It does. Especially when interest rates are on the...
Yeah, it's going to be a busy day, busy week for all of us here. Thank you so much, guys, as always, for joining, Eva and Costa. Thank you so much. If you want to hear more from the Broker Daily Network, go to brokerdaily.com.au. But for this week, thank you and goodbye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.